Hi, everybody, and welcome back to video number 5 in chapter 19. And when we left off, we were looking at what minimum amount of amortization will Lasso record in 2025, 2026, and 2027. And we're going to assume that the average remaining service lives for all employees is 5.5 years. Okay, so the schedule to amortize the net gain or loss is shown here. And here we have the projected benefit obligation, the plan assets, our corridor, and the accumulated other comprehensive income, gain or loss. And then we have the minimum amortization loss for the current year. So all of this is at the beginning of the period. 10% of the greater of the projected benefit obligation or plan assets market related value. And then calculation of amortization net loss is going to be 400,000 minus the 280,000 divided by 5.5 years. And that's how we get the $21,818 amortization, which will increase pension expense. Now, the calculation of the amortization loss for 2027 is a two-step process. First, we calculate the updated balance in the accumulated other comprehensive income. And here's our net loss less the 2026 amortization, and that gives us our ending net loss balance for 2026. Then our loss increase for 2027 is going to be $300,000. And so we add those two together, and that gives us an updated net loss balance for 2027 of $678,182. So then we calculate the amortization of net loss by taking this $678,182 and subtract $290,000 and then divide that by 5.5 years. And that's how we arrive at the 70,579 amortization, which will increase pension expense. The loss recognized in 2026 increased the pension expense by $21,818. This amount is small in comparison with the total loss of $400,000. It indicates that the corridor approach dampens the effect, reducing volatility of these gains and losses on pension expense. Okay, here let's continue with the Zarl Company example. And the following facts, here we have our annual service cost, our settlement rate of 10%, our actual return on planned assets of $12,000, the amortization of prior service costs of $20,800,000, annual funding contributions of $24,000, and benefits paid to retirees during the year are $10,500. So some changes occurred in actuarial assumptions, and it resulted in an end-of-year projected benefit obligation of $265,000. So the question is, what is the pension worksheet you would prepare for Zarl's pension plan in 2027? So as we look at this and plug our numbers into the worksheet, we have our normal entries here, I'll let you look at that a little bit. Compare it with our numbers here. And so what we're going to do next is, given the projected benefit obligation balance unadjusted at December 31, 2026, and the related transactions occurring during 2026, the PBO balance to date is computed by taking that 212,700. We get that from here. And we add the service cost. We add the interest cost and the benefits paid as a subtraction. And that gives us our projected benefit obligation balance before liability increases at the end of 2027 of $236,470, as shown here. Okay, recording pension. Now the difference between the ending balance of $265,000 and the balance of $236,470 before the liability increase is $28,530. That $28,530 is an increase in the employer's liability and is an unexpected loss. So, continuing with this example, we're going to pick up our benefit expense. Let's go back here. We're going to pick up the other comprehensive income, credit cash, credit other comprehensive income, and then we have the pension asset liability here of $26,800. Okay. So our projected benefit obligation, this is a credit, $265,000. The plan assets its fair value is $159,600. So the pension asset liability is a negative $105,400. All right, so if we continue with the Zarl company for 2028, we have our service cost, our settlement rate, our annual return on planned assets, our amortization of prior service costs, annual funding contributions, benefits paid to retirees during the year, and the average service life of all covered employees is 20 years. Now we'll prepare our pension worksheet again for Zarl's 2028 information. And here it all is, as shown. Let you look at that for a second. Okay, so now at the beginning of 2028, the balances on the worksheet are shown. Entries alpha alpha through golf golf are similar to the corresponding entries. Here we have our golf golf, etc. And they're similar to the corresponding entries previously explained in prior year's worksheets, with the exception of entry delta delta. In 2027, the expected return on planned assets exceeded the actual return, producing that unexpected loss. So in 2028, the unexpected gain or loss is calculated by taking the $159,600 times 10%, or $15,000 $22,960. The $22,000 actual return is greater than the expected return, the $15,960, by an amount of $6,040. An asset gain, entry delta delta, and then by netting the $6,040 against the actual return of $22,000, pension expense is affected only by the expected return of $15,960. Okay. In the next bullet point, the new entry, hotel, hotel, in Zarl's worksheet results from the application of the corridor test on the accumulated balance of the net gain or loss and accumulated other comprehensive income. Let's go back and take a look at that. Okay. And Zarl begins its 2028 with a net loss balance of $29,940. The company applies the corridor test to 2028 to determine whether the balance is excessive or should be amortized. In 2028, the corridor is 10% of the larger of the beginning of the year projected benefit obligation of $265,000, or the plan assets $159,600 of market-related asset value, assumed to be fair value. So the corridor for 2028 is $26,500, computed by taking $265,000 times 10%. The net loss balance in accumulated other comprehensive income is $29,940, and it's greater than the corridor. Therefore, the excess must be amortized, as shown here. We take the $29,940 that we calculated here, back out the $26,500, which we calculated here, and divide that through by 20 years. And we calculate $172 of amortization for 2028. And then finally, the amortization of the net loss increases pension expense. In the 2028 pension worksheet, Zarl debits the pension expense for $172 and credits that amount to other comprehensive income, gain or loss. Okay, Zarl records its pension expense as follows. Pension expense, $44,312. Debit pension asset liability, $6,500. And then we credit cash for $27,000. Credit other comprehensive income, gain or loss for $6,212. And finally, we credit other comprehensive income for $17,600. Okay. Now we'll move on to describing the requirements for reporting pension plans in financial statements. And here we report pension plans and financial statements in 4 categories. 1, assets and liabilities. 2, net income. 3, comprehensive income. And 4, notes to financial statements. And then for assets and liabilities, the company must recognize on their balance sheet the overfunded pension asset or underfunded pension liability status of their defined benefit pension plan. And if the fair value exceeds the projected benefit obligation, companies will report a net pension asset. No portion of the pension asset is reported as a current asset. That looks like a good place for us to stop this video. And when we return, we'll take a look at net income. Until that time, bye for now.